friends, welcome to the target series for BFM, for June target, right? In this series, we are covering all the numericals, objective questions, case studies related to BFM as well as other subjects. ABM, ABFM, BRBL, those are also covered by various mentors. I am covering ABM also and BFM also. ABM module A and C and BFM complete. So today, I'll be covering the chapter Module D, Unit 31, REROC and Profit Planning. Last chapter of your Module D. But equally important, the importance of REROC, now it's very underlined in every bank. Risk Adjusted Return on Capital. The most important one. Okay? So you need to first understand what is REROC. Okay? So let's start first. Case study. Dual mandate of the banking institutions. So first they understand dual mandate means what? Two things. We have to focus on two parts. So the bank functions as the critical financial intermediary that must navigate a complex landscape, balancing the aggressive pursuit of shareholder profitability and high returns on equity with their fundamental ethical duty as trustees to safeguard the depositors' funds, right? So bank must first focus of bank is what? It is an intermediary. Okay, it's an intermediary means what? A middleman. So we are middlemen, intermediaries between the depositor and the borrower, right? That must navigate a complex landscape, balancing the aggressive pursuit of the shareholder profitability. So first profitability, first job is profitability and high returns on equity. So profitability and high returns with the fundamental ethical duty as trustees to the safeguard. So this is the second part, trustees to safeguard the depositors' funds. So now see this, the rule of banking or rule of finance is what? Anywhere you go. High risk, high returns, right? High risk, high returns. So now if you see it over here, the point over here is you need to give the investors high returns, profitability, right? And high returns on equity. But if you want to give high returns, then you'll have to take high risk. But if you take high risk, then there's a problem. Why? Because we are trustees to the depositors' funds. Tomorrow in pursuit of going for very high returns, if we take high risk, and tomorrow if that risk goes in a negative way, then what about the depositors' funds? After all, it's a trust which they have shown on us, right? It's basically the logic of trust, right? They have trusted us and given us the funds, right? This dual mandate, so these are the two jobs. Dual mandate means these are the two jobs. One, high returns, and second, safety. This dual mandate necessitates a sophisticated approach to prudent risk management, requiring banks' leadership to strike a delicate equilibrium between credit disbursement, strategic investment portfolios, and the generation of non-fund or fee-based income. Fee-based income, see this. This dual mandate necessitates, means makes it compulsory for us as bankers. A sophisticated approach to prudent risk management. Prudent risk means what? You cannot take excessive risk in your bank. Banks are not allowed to take excessive risk. Prudent, whatever has been specified by RBI, you have to follow those guidelines only. You cannot go beyond that. Prudent guidelines, okay? Requiring bank leadership to strike a delicate equilibrium between the credit disbursement. Equilibrium means balance. You have to balance, right? Credit disbursement, strategic investment portfolios, and generation of non-fund and fee-based income. So three things you have to focus on, okay? One is credit, loans. Second is strategic investment portfolios, means investment in bonds. in debentures. You can invest in that. And third one is generation of non-fund based fee income. Okay, fee income, TPP, third party products. So these three are compulsory. These are the basic jobs of bank nowadays, isn't it? The internal balance is further moderated by external pressures. See, further moderated by external pressures, especially stringent regulatory frameworks such as SLR, statutory liquidity ratio, which mandates that a specific portion of the assets to be held in secure government securities to ensure systemic stability and protection of public interest, right? So, the internal balance is further moderated by external. What are the pressures? SLR. See, SLR is the biggest pressure on the banking. So, banks have to invest into SLR and invest in bonds, and those also safe bonds. Generally government bonds only, T-bills or dated securities, anything, but safe bonds. So when you invest in safe bonds, obviously low risk or low returns. You will get low returns over here, right? So this SLR will create a negative carry, you can call it, or lesser returns, you can call it. See, CRR always has a negative carry because you don't get any interest on it. SLR also you don't get any interest, but the bonds in which you invest, see, SLR is always invested in bonds. So the bonds in which you invest will give you coupon. So that coupon is your income. But CRR, it's in cash, so nothing you get. So now, up till now you have understood this case, right? This paragraph talks about SLR and this paragraph talks about the dual mandate. Okay? RAROC is basically what? Risk adjusted return on capital. Dual mandate. So you want the return on capital also and RA, risk adjustment also. You can't take excessive risk also. So that's why we have the risk adjustment. And return on capital means high returns. So you can call it prudent returns, not very high returns. Okay? Got it? So now let's move on to the questions. Which of the following best describes the agency conflict inherent in the bank's operations, operational structure according to the text? So which reflects the agency conflict? Agency conflict means you are having a dual mandate. The conflict between industry lending and agri lending. The variance between the maximizing shareholder returns and fulfilling the trustee role for the depositors. The struggle between generating fee-based income versus treasury income. The tension between local banking norms and international SLR standards. So the answer is obviously over here, right? The answer is, right? The answer is quite obvious over here. It is not related to agri, not related to lending, right? Dual mandate is related to your returns and trustee. So the answer is correct, B, isn't it? Trustee role may be at variance with the maximizing profits of the owners. It's always a dual mandate. I have to get the returns also, but manage the risk also. Both the things, right? Next, a bank's sacred duty primarily dictates that. So what is the sacred duty of a bank? It must ensure the highest possible return rates, possible interest rates for all the loan products. So it must ensure highest possible interest rates for all the loan products. It must prioritize non-fund based income to avoid balance sheet risks. It must act with extreme caution to protect the principal and the interest of the depositors. It must invest 100% of its equity into government securities to ensure zero risk. What is the sacred duty? Sacred. What is the prime duty of any bank? Yes, what do you think? Simple, isn't it? What is the prime duty? Prime duty is this, right? It must act with extreme caution to protect the principal and the interest of the depositors. Right? C is the answer. Got it? C. Next one. In context of the profit planning, balance sheet management is most accurately defined as a coordination of. So, balance sheet management is defined as a coordination of what? Coordination of only interest-bearing assets like loans and bonds, staffing costs and administrative overheads, credits, investments and non-fund based income streams. Managing the SLR exclusively. So, balance sheet management means what? What have I to coordinate? What have I to check? See, I have to maintain a balance between various revenue streams and various expenses, so that the assets in the balance sheets, I have to focus. See, nowadays balance sheet asset means what? It's basically your this assets, current assets, basically your loans, and current liabilities are related to your deposits. So you have to balance the assets and liabilities so that the buckets are managed, maturity mismatches are managed, right? And you get a net profit also, right? Nowadays, these balance sheets have been shifted to vertical form of balance sheets, sources and application of funds. Sources and applications. We don't call it assets and liabilities nowadays. It's called as vertical form of balance sheet. And your P&L is also shifted from profit and loss account to income and expenses statement. P&L is nowadays called as income and expenses statement. And balance sheet is called as sources and application of funds. This is a vertical form of balance sheet and P&L. Okay. So, it accurately coordination of what? Means what should I coordinate? So, only interest bearing assets like loans and bonds, staff cost, administrative overheads, credit, investment and non-fund based income statements. Isn't it? Answer is C. Correct? Credit, investments and non-fund based income streams. Got it? See, just now we did this, right? Invest non-fund based income streams means your non-fund based means LC, bank guarantee, all these. Okay? Investments, credits, and also you have to look at this TPP income nowadays. Next. If the bank increases its exposure to high risk industrial credit to boost return on equity, which regulatory or ethical pillar is it most likely straining? Oh, so typical question. See, if we shift our focus from retail banking or retail funding to corporate funding, then what are we harming actually to get return on equity? So what are we actually harming? The financial intermediary role, the prudent management of trustee responsibility, the treasury income mandate, the fee-based income strategy. So what am I harming? Which of these I am harming? Which of these I am harming? Yes? If a bank increases its exposure to industrial units, high risk. See, industrial units are generally high risk. Okay? So if I increase my exposure to high risk industrial credit, so what am I harming? I am harming the correct trustee, right? I am harming the trustee responsibility, because what the depositor has given me the funds, assuming that I will give the loans to safer industries and safer customers. And if I am deviating from that, it's actually the trust from which I am deviating, isn't it? Isn't it the point? So, the answer is B. High risk lending conflicts with the trustee role of protecting the funds. How does the SLR impact the profit maximization objective? How will it affect profit maximization? What is profit maximization? Profit maximization means I must get the maximum profit available. Means highest profit. But there's a problem, as I told you earlier. High profit or high gains means high risk. And what does the SLR do? SLR, you have to invest in government securities, dated securities, mainly dated only. Bonds, government bonds. So those will give you lower returns. So how does the SLR impact the profit maximization objective? It increases the profit by forcing the banks to invest in high yield private equity, high yield. In SLR, do you invest in high yield private equities? It is neutral as it only applies to non-fund based income, non-fund based income. It may constrain profit potential by mandating investment in the lower risk government securities. So constrain the profit potential again by mandating the investment in lower risk government securities, right? It eliminates the need for any other form of risk management. So what do you think? SLR. How does SLR affect your profit maximization theory? We in bank nowadays don't focus on profit maximization. We focus on profit optimization, not on maximization. Okay? So may constrain profit potential by mandating investment in the lower risk government securities. What do you think? C, correct? SLR mandates investment in the lower yielding securities, limiting capital for high profit lending, right? If I invest in low yield government securities, I won't be able to give the loans to high yield industrial units. But those are risky, right? So you have to manage the risk also. That's why RBI has mandated the SLR. Got it? This is another case study. Next one. Read this. Now it's very typical one. Typical one from risk factor. Assume the FX and bond traders, means there is a FX trader and a bond trader. There are two traders. Forex trader means the one who deals in dollars and currencies, and second one deals in bonds. Have notional amount and volatility as described below. So both are given certain funds. Okay. So let's look at what are the funds. The bond trader deals in larger amounts. So bond trader will need higher amounts, 200 million. But in market with lower volatility at 4% per annum against 100 million and 12% per annum for FX trader. The risk capital can be computed as VAR measure, say 99% level over a year as Bankers Trust did. Who is performing better? So now the question is, now this is what you will have to check. See, pay attention. There is one FX trader, FX, and second there is bond trader, bond trader, right? This FX trader is having what amount? $200 million, and this FX, what is this? Bond trader, sorry, reverse I have done what? Yeah. So here it is $200 million. Bond trader is having $200 million, right? And this FX trader is having $100 million. Say this 100 million, right? So 200 million for bond, 100 million for FX. What are the returns? Look at the returns. Lower volatility, 4% returns, 200 million and 4% returns. Your returns are 12%. 12%. Okay. Now, the risk capital can be computed as VAR measure, say at 99% level over the year as bankers trust did. So 99% risk you can take it. So 99% risk means what? Now you'll have to go back to ABM. It is 99.7 actually. It is 3 standard error. Okay, and at 99% you will be having 2 point something. You can take it any figure, 2.67 you can take it, 2.7 you can take it. Okay. So now you have to give me who is performing better. Generally, what do we think? Suppose if you look at this figure only, you will say obviously sir, 100 million, 12%. So in a year, how much will I be earning? I'll be earning 12% into 100. So I'll be earning 12 million. So my returns, look at these returns. Returns is 12 million in 1 year, right? Over year, 200 million and 4%. So my returns are what? 8 million. But my returns are 8 million over year in 1 year. But to get a return of 12 million, what have I invested? I have invested 100 million, right? So what is my yield? If you say yield, so yield is 12 million upon 100, so 12%. And here the yield is 4% upon, because you have to look at what capital you are investing. So here the yield is 4%. So you'll obviously say, sir, he is doing better. But we have not seen the risk part over here. The topic is known as RAROC. This is an important topic, RAROC, risk adjusted return on capital. So now let's look at the answer. Assuming normal distributions, this translates risk capital of VAR as 100 million, okay, into 0.12, 0.12 into 2.33. What is this 2.33? This is the figure which I told you, 99% risk. It's a normal distribution. See, 99% means what? This is the normal distribution curve. Again, ABM. Okay, 99% over here. So we'll be taking for 99.7%. It is 3 standard error. So for 99, it will be 2.33. Now this figure you don't have to remember. You will be given in the exam. So now if you see, what is the risk capital? Risk capital, how much capital is at risk? 100 million, okay, into 0.12. 0.12 is my returns, right? Into 2.33. So 28 million, okay, that this translates the risk capital of 28 million for FX trader. The risk adjusted performance is then measured as the profit divided by the capital. So profit divided by capital, okay. So profit divided by capital means here what will be the answer then? Look at it now. So RAPM, risk adjusted profit measure, equals to profit upon risk capital. Now you check the answer. So profit upon risk capital. So what is my profit? Look at the profit part now. Upon the risk capital. Thus the bond trader is actually performing better than the FX trader as the activity requires less risk capital. So the risk capital for the bond trader is less. More generally, risk capital should account for credit risk, operational risk and any interaction. See this. What is given? 4% per annum is the volatility. It was not, it's not returns, it's volatility. I thought it's returns. So it's volatility V. Here also it's volatility V. Okay. So volatility is 4% over here. So how much fluctuation is happening? Only 4% in case of bonds. And in case of this FX, it is 12% happening. So if we calculate this, let me do the calculations over here. Okay. So this is, let me do the calculations. So what are the calculations in this? Look at this. This calculation we have done. This is for FX, right? FX. So get the answer, 100 million into 0.12 volatility into 2.33. So your risk capital becomes 28 million. Okay. So now what is your RAPM? RAPM means what? RAPM means risk adjusted performance. So whatever is the profit, okay, is the returns given over here? Returns. Returns are not mentioned, and 12% for the volatility against this. But the market has lower volatility. Yeah. Returns are not given. So let's assume they get a similar return or any X amount return. Okay. So if I calculate RAPM for FX trader, so it will be X upon, what is it? 28 million. So this is my RAPM for FX. Now suppose if I find out the same RAPM for my bonds now. So 200 million into 0.04. See, this is 12%, right? And that is 4%. See this, 4%. So 200 million into 4% into 2.33. So bond it is 200 million into 4%, right? Into 2.33. Now get this answer. 4% means divided by 100. Okay. So 4 to the 8 and 2.33 into 8. So what is the answer? 2.33 into 8. So what will be the answer over here? Everyone? So it is 18.64. So my risk capital is 18.64. So now if I calculate my RAPM with respect to the risk capital. So for bonds it is bonds. It is X upon 18. It is X upon 18.64. So who is better? For earning a profit of X, I am requiring 28 million over here as put at risk. See, 28 million I have to put it at risk. And here for getting the profit of X, I have to put only 18.64 at risk. So it means that the bond trader is performing better. Bond trader is actually performing better than the FX trader, as the activity requires less risk capital. Okay. More generally, risk capital should account for credit risk, operational risk, and any other interaction. So basically, it should account for all the risks, right? That's what the logic is of risk capital, right? Got it, everyone? Clear? A dash framework will translate organizational strategy into appropriate functional level goals which can be tracked and monitored at the right levels and frequency to deliver predictable improvement in metrics like ROA and thereby valuations. So which framework will help the bank to achieve the ROA? See, all these things are okay, simple logic. In exam, you have to first remove the scrap from the problem. Remove what is not required. Simple logic is which framework, and it will help you to achieve this ROA. Simple. Which framework will help you to achieve the ROA? That's what the question is. profitability based performance management, business based performance management, revenue based performance management, and asset based performance management. All of you will think everything is correct. What's wrong in it? So frequency and deliver predictable improvement in the metrics like ROA. Now for this you need to first understand the meaning of ROA. Okay? ROA you have to understand the meaning. Return on assets. Once you understand the meaning and full form of ROA, then immediately things become easy. Return on assets. So asset-based performance management. Simple, isn't it? For that you should know the meaning of this. ROA or full form of this. So the answer is this. Asset-based performance management. If you want to get into the metrics like ROA, what is ROA? What are my total loans? And what are my total returns from that? Interest part. So that's basically ROA. Got it? To improve ROA and reduce variability in the performance, banks need to take forward-looking windshield-based approach to performance management rather than backward-looking rear-view-based, mirror-based approach. This would include which of the following framework? So, forward-looking approach, understand the question first. Do you want a forward-looking approach or do you want a backward-looking approach? That's the only question. Do you want a forward-looking approach or do you want a backward-looking approach? That's the only question over here. Yeah. A SMART. What do you mean by SMART? Specific, measurable, achievable, relevant, and timely. KPI framework and hierarchy for each business. Linkage of ROI targets to lower level financial goals, lag indicators, and operational parameters, lead indicators, and mapping them to the organizational hierarchy. Improved linkage between ROI improvement and the compensation and reward structure, and all of these. Pay attention to the question first. Observe these options also. SMART. Specific, measurable, achievable, relevant, and timely. Full form of SMART. This full form can also come separately in the exam. Specific, measurable, achievable, relevant, and timely. So do you need these elements? If you want to measure the performance of any bank, do you need these elements? Obviously you will need it. SMART technique. So this is true. Linkage of ROI targets to lower level financial goals, lag indicators, and operational parameters, and mapping them to organizational hierarchy means giving specific targets to specific persons, to a level-based person. So do you need that? Obviously your regional manager will have higher targets than you, isn't it? Because the regional manager is controlling the region. You are in the branch. So hierarchy based. So that is also right. So this is also true. Lead and lag indicators. Understand the meaning of lead and lag indicators. That is also important. Lag means what? Which will give you the solution or the analysis after the thing has happened. Lead means it will give you the solution or analysis before the thing happens. What can happen in future? Lead. This is also called as back testing and stress testing. Okay. So here ROI linked to the lag indicators and lead indicators. So that is also true. Improved linkage between ROI improvement and the compensation and reward structure. Target based, simple, target based. You do this much, you will get this much. You don't do this, you won't get it. Should we do the same in the banking? In fact, it is done in the banking. Right now also it is done in the banking. Okay, so the answer is all of the above. This is the right answer, D, all of the above, because all of them are compulsory if you want the bank to grow, isn't it? In the final phase, starting in the 90s, the government set up Narsimham Committee to manage the major reforms including liquidity standards in the banking sector. Which of the following is not the recommendation made by the Narasimhan Committee? Kindly note, Narasimhan Committee was an important committee in 1991. This committee, because of this committee, whatever banking we are seeing today, the speed, the private banks, the competition, it is because of this committee. Earlier, before Narasimhan Committee, the Narasimha Rao government, okay, that opened up the economy. Before the Narasimhan Committee, the banking was very sluggish, very sluggish. Now the banking has changed a lot. So, which of them are not the recommendation? Regulation of interest rates, reduction of CRR, reduction of SLR, opening up of the sector for the private and foreign players. What was not the recommendation? Kindly focus the question. Not the recommendation. Narasimhan Committee was actually against this. So you want not. Narasimhan Committee was against this regulation of interest rate. It clearly said that RBI should come out of this job of regulating the interest rates. Before that, if you see, banks were given the FD rates also by RBI. FD rates also. Loan rates were given, but FD rates also by RBI. Means RBI gave literally the loan rates and FD rates to the banks. So Narasimhan Committee was against this, and this was not the recommendation. Remaining three were the recommendation: reduction in CRR, SLR, and opening of the sector for private banks. Among the below mentioned ratios, which of the following is not a part of common profitability ratios? So profitability, which of them is not the part of profitability ratio? Now for that you need to first understand what are the types of ratios. Ratios are of three types mainly: profitability, solvency and turnover. Okay, profitability, okay, second is solvency, and third one is turnover. TOL, write it, turnover. These are the three main types of ratios in ratio analysis. Profitability has 5 types of ratios. Okay, PE ratio, PE and this EPS. Okay, gross profit, net profit, and overall profitability. These are the 5 ratios in profitability. PE, EPS. Okay, so PE, EPS, gross profit, net profit, and overall profitability. Got it? Next, now which of them is not? Which of them is not? Kindly note, not a part of profitability. So 5 ratios I gave you regarding profitability: gross profit, debt margin, operating margin, and return on assets, return on sales. So which of them are not the part of profitability? Gross margin, gross profit ratio, it is there. Operating margin, operating profit, it is there. Overall profitability means operating. Return on assets, again it is there. Debt margin is different. Debt margin is not the right answer. It's not the part of these 3 ratios. Okay, it's actually, you can relate this to debt equity ratio, but that will be the part of debt equity, that will be the part of solvency, long-term solvency. Remaining 2 I'll explain you whenever some topic comes. Okay, so the answer is this. Required answer is this. Debt margin is not the part of your profitability ratio. Got it? This is not the part. So got it? Debt margin is the answer. Debt margin. Okay? Among the below given, which of the following actions to be taken for implementing the strategy objectives? Strategy objectives, okay? Implementing the strategy objectives. So, long-term strategy. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premium. Difficult words, isn't it? Elongate the maturity of the debt portfolio. Build a balanced maturity profile and supply along the yield curve, and all of the above. Strategy means you are thinking of long term. Whenever you are thinking of long term, the first question comes in mind is yield curve. Yield curve is something which is very important for long term survival of any bank. So obviously this answer will be there. Build a balanced maturity profile and supply along the yield curve. Elongate the maturity of the debt portfolio. This is also one of the important strategies. If you have the loans of longer duration, okay, loans of longer duration, and similarly deposits also of longer duration. Not too long, because deposits too long is always a risky part. If you have it linked to the repo rates, then it's okay. But deposits in our country as of now, we are not in the repo rate style of deposits. Loans we have repo rates. So always the more longer you have the loans linked to the repo rates, the better it is for the bank, isn't it? So this is also elongate the maturity. That is also true. So now if two are true, obviously the answer will be all of the above. But for that you will have to check first whether this first one is also true. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premia. If you are having a liquidity, huge liquidity you are having, means you are having excess funds. Take advantage of that. Liquidity means what? The bank is having excess funds. So if I am having excess funds, I will lend it at a lower rate. So take advantage. All of the above. Correct? D is the answer. Which are the reinforcing pillars of Basel II revised framework? Minimum capital requirement, supervisory review, market discipline. A and B, B and C and A, B and C. See, Basel II revised framework. So which are the pillars? Is it minimum capital requirement, supervisory, market discipline? This is the easiest question for CAIIB level. This is the easiest question for CAIIB level. Think over it. Let me see. This you have done it in your JAIIB also, isn't it? So the answer for this is all the three. All the three are important. All A, B and C. Okay, all the three are important. In fact, Basel III also has the same ones. Only in Basel III what you have, everywhere you have the word enhanced. Enhanced. Everywhere. Here also, here also. Basel III has only one word which is added, that is enhanced minimum capital, enhanced supervisory review, enhanced market discipline. Pillars are same. Okay? Which of the following stress testing techniques specifies the shocks that might plausibly affect several market risk factors simultaneously if an extreme but possible event occurs? So, which will give you all the events occurring at the same time? All the events. It can happen. Repo rate is going up, then there is a war going on, GDP is going down, your bank is facing the problem internally. All the things can happen at the same time. So, simple sensitivity, scenario analysis, maximum loss and extreme value theory. Which one will give you the scenarios of various market risk factors, several market risk factors simultaneously? Many of you will get confused over here between this and this. Or some of you might think this also, maximum loss. Okay? Maximum loss also, because some of you might think maximum loss, all the things coming at the same time, so maximum loss. But it's not the answer. Maximum loss is not the answer. EBT is also not the answer because EBT is different. EBT is not all the things coming at the same time. EBT is basically the market crashes like never before. That's called as a tail concept. So this is also not true. The true is this one. Scenario analysis. Various scenarios you have to consider and take various options into consideration. Various points can happen. COVID can happen, your interest rates can suffer, there can be a war between various countries. All the things can happen. So that's why scenario analysis is the right answer. Scenario. And in that also, in scenario, you have one basic method. Means various scenarios are considered over here. Okay? Means all good and bad scenario. What is scenario basically? You are basically combining various elements. One name in that is Monte Carlo simulation. Monte Carlo is one of the best methods for scenario. Okay, you have a lot of questions on Monte Carlo. Kindly note. Monte Carlo simulation. One of the maximum asked question in the exam. Okay. Read this. Which of the following statements is or are true? Which of them is or are true? Assets and liabilities in the trading book are held until maturity. You want correct one, sir? Mark-to-market system is followed in the trading book. Derivatives are held for trading in the market or over the counter are not the part of the trading book. Derivatives that are held for trading in the market or over the counter are not the part of the trading book. Trading is subject to adverse movement in the market prices until they are liquidated. So these are the four options. Which one of them is correct? Think over it, everyone. Assets and liabilities in the trading book are held until maturity. Is it so? Assets and liabilities in the banking book are held until maturity. So this is false. Mark-to-market system is followed in the trading book. True. What is mark-to-market? Mark-to-market means notional profit or loss. Suppose if I purchase, let's say a Reliance share today, example I am giving, a Reliance share or any company share. Let's say I purchase it at 2000 rupees. Then tomorrow I am not going to sell it. But tomorrow if the price goes down from 2000, it goes down to let's say 1900. Am I selling it? No. But I have a notional loss of 100 rupees. So if I have this notional loss and if I am in the options market or if I am in the futures market, then I'll have to pay that loss from my pocket, from my savings account. That is called as mark to market. The reverse is also true. If I buy it at 2000 and tomorrow it goes to 2100, I am not selling it. But the difference between the same is given to me. This is generally done in the futures market. Futures is also always mark to market. Okay? Derivatives that are held for trading in the market over the counter, market or over the counter are not the part of trading book. What are the types of derivatives? One is in the market and second is OTC. There are only two types of derivatives in banking. One is ETC, second is OTC. Exchange traded, and second one is over the counter. So if both are not there, what is mentioned over here? Derivatives that are ETC or OTC are not the part of the trading book. Then what is trading book? What is trading book? Trading book means anything. It's also called as a proprietary book. This is also called as a proprietary book. Proprietary means what? Here I am buying the share, buying the stocks, shares or commodities or bonds for my own profit. Own profit. I as a bank want to earn the profit. So that's why I am buying it. So derivatives are held for trading in the market or over the counter are not the part of trading book. So that is false. That is a part of trading book. Okay. So 2 is correct up till now. Trading book is subject to adverse movement in the market prices until they are liquidated. What do you mean by this word liquidated? I'll give you a simple example. Again, the same example. I buy a share of, let's say, Reliance or any company. I buy that share. So, up to what time will I be concerned about the price of this company? Suppose if I buy it at 2000. So, I will check the prices daily or weekly or whatever frequency it is. What is the price today? 2000 I had bought. Is it 2200, 2300? Is it 1800? Is it 1700? I'll check the prices. But up to what day will I check? Suppose if I sell the share after, let's say, 5 days, sell that share. I had purchased at 2000, now I have sold it at 2200. I have sold it. So after that, will you check the price again? Unless you have to buy it again. Forget the buying part. But will you check it with the risk factor that whether it is going up or down? You will not check because you have already sold the share. That is known as liquidation. So you will always check the price, or it is always subject to market movements or market prices subject to you have not liquidated it. So 2 and 4. 2 and 4. This is the correct option. 2 and 4. Again, see this question. Very important one. So now, everyone, before going, see the new batches of Adda 24/7 have just now started. They are still in the starting phase. Officers Pro Batch for CAIIB. All the numericals, objective questions, case studies, everything is covered. You get e-books, mock tests, everything. And discount is huge. See this. Let me show you. Click on buy now. Okay, put the code Y432. Y432. Click on apply. Look at this. 81% discount you're getting plus 1% extra by downloading the app. So 82%. In fact, I would suggest you to join rather than joining a single batch. I'll always suggest you to join the Increment Mahapack. See, Increment Mahapack which you get over here at Adda 24/7, CAIIB Increment Mahapack. Look at this. If you check the CAIIB Increment Mahapack, see this. Triple validity offer is going on right now. Triple validity means you buy for 5 months, you get it for 15 months. You buy for 9 months, you get it for 27 months. So triple validity plus 81% discount is there, plus 1% by downloading the app, that is also there, extra. Here in Increment Mahapack, you get 15 plus batches per subject. Plus you get this physical question bank delivered at your home for all the subjects. Plus you get the formula bank delivered at your home. Plus the study planner. All these things you get. Plus in Mahapack you get one important part, that is elective lectures also. So don't miss all these. And once you join the Increment Mahapack, you need not join any of the batches. Everything will be included in this also. This batch, coming batches, all the batches. But never forget the code Y432. Okay? Bye.